This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to take a look at the market trade from Friday and the past week of action, we are joined by our good friend Ted Seifried with Zaner Ag Hedge. Ted, good to catch up with you, buddy. How are you today?
Doing great, Jesse. How are you, man? It's Friday.
I
Happy Friday.
Yeah, I am doing good, man. Glad to have you on the show once again here today. And, looking at Friday's markets, kind of like watching paint dry. It's kind of felt that way to me all week. There's been this lack of fresh news, really. We did see the dollar break midday Friday, mid morning Friday. That gave us a little room to run, but even then we didn't really move that much higher in the grains and livestock. I don't know. Overall thoughts just with Friday and the week. I know we'll dive into a few other, topics, but just overall, did it feel that way to you? Just a lack of fresh news all week?
Yeah, fairly tight trading range for the week. We were just a little bit higher in grains, ended up the week. And that's probably a good thing because the end of last week, it maybe almost felt like we were going to try to probe to the downside. But, for the most part, we're really sideways right now, Jesse. And we've been really sideways for a little while. We've got sort of contradicting things going on for grain markets in the sense that you've seen crude oil come well off its highs. You've seen a lot of commodities come well off their highs, but at the same time, we had this late season weather issue for grains and questions on production, and that kind of helped keep us sort of treading water.
Mhm.
And if you look at corn, I mean, we've been in a really tight trading range for the past month and a half, almost 2 months. So at some point, we'll break out one direction or another. It's just a question of which way and when. Uh, and I guess that all remains to be seen. I think you said it. You hit the nail on the head there when you said that the dollar was really the talking point on Friday. Um, yeah, we were sharply higher in the night session, and then we ended up sharply lower. Like you said, breaking right as the grains opened, and we kind of continued down there throughout the day. So that added some support, and it allowed grains to come back off their lows. Night session was heavy because of that higher dollar, but when the dollar started breaking off the highs and went negative on the day, grains were able to muster some strength and get back up. Now, we didn't see a big breakout to the upside though either, so really just kind of made for again some more sideways trade for now here, Jesse. Um, you know, I, I will say this. The soybeans, on a chart are kind of threatening for a little bit of a breakout of the upside. And a lot
Mhm.
of it has to do with the strength that you're seeing in soybean oil right now. Soybean oil has just really been on fire. I think if we're going to talk about the week, that's really been the highlight of the week has been the soybean oil market. And for a couple of reasons. We
Sure.
know diesel fuel is really, really high right now. Global veg oils are a question mark. I mean, it's tight supply. We're worried about the export corridor for the Ukraine and the Black Sea. That could leave a hole in sunflower oil and therefore veg oil exports. So yeah, again, that's the story of the week is soybean oil sharply higher, and the beans have caught some support on that. And then the soybean chart itself kind of looks like it might want to flirt with the idea of a breakout to the upside.
Well, I know as well, Ted, on Thursday, we saw the weekly export sales numbers really good for beans. We knew that was going to be the case with all the China sales. And then even on Thursday as well, we saw more China and unknown sales, probably China, we assume. But, you know,
Wink,
uh,
wink.
watching that export front, I know it's been a big question mark. Corn and wheat are still kind of lagging. We have the river issues out there. It's not going to solve itself anytime soon. But you look at exports. How do you feel about things right now? I'd have to think soybeans. Maybe there's some glimmer there of hope right now, Ted.
Yeah, a glimmer of hope. We've had two good weeks in a row. Um, So that's something. It's a start, but we really missed out on the September exports that we're normally used to seeing, and that's because Argentina was offering their currency exchange rate for their exporters and for their farmers to sell beans aggressively, and they did. So now we have a shorter window of export opportunity. We're going to have to keep the pedal to the metal here for the foreseeable future, at least until, gold exporters see Brazil. If they're having a good crop, they'll really back away from us. We know that's going to happen 3 or 4 weeks from now, potentially. So, yeah, we need to see those numbers keep up. And then the other question, Jesse, is with the struggles that we're having with the Mississippi River and getting grains to the Gulf, the Pacific Northwest, we're really going to have to lean on them.
Mhm.
And can we keep up the shipments? And if we can't keep up the shipments, are we going to keep up with the sales? So that's something to be watched very, very closely. In the meantime, what ties into that is South American weather. Like I said, if South America is looking good, well, global end users might shy away and try to kick the can down the road and wait for that crop to come along. And you've got some hints that Argentina weather might be getting a little bit better. So you do wonder, are we going to keep those export sales up? Are we going to be able to get the product to the Pacific Northwest and keep moving the product, soybeans in particular, out of the Pacific Northwest? And then corn, this is not our seasonal time frame to be super aggressive on exporting corn, but the numbers should be a lot better than they are right now. And that's a concern. That's a big concern, really. And you go back to the price levels that we're at and how long we've been up at these price levels, and you say, wow, are we really now starting to export or ration that export demand at this point? And if that is the case, and we end up seeing an export number well below what the USDA's current forecast is, well, then the tight situation that we perceivably have in the corn market for this marketing year might not be so tight anymore, and it might be very tough to
Mhm.
justify these prices further on down the road. But for now, we're far enough away from the end of the marketing year that the market's very reluctant to give up on the idea of exports yet. But if this keeps going on the way it has been, and we continue to have problems with the Gulf, yeah, I don't know. It's going to get a little bit dicey.
Well, throw on top of that moving product as well. You talked about the PNW rail. I know rail is back in the news this week, starting to be more of a worry again with a potential rail strike. Some folks are leaning towards the thought that it's just a political play and there won't be a strike, but it's still out there. If that happens, we talked about this before, it could be catastrophic for ag, Ted.
Well, yeah, absolutely. I mean, diesel prices are super high, so trucking is a problem, right? We know about the problems with the river, so putting grain on a barge is a problem. You take the rail away, what else do we have, Jesse? I mean,
Mhm. Carrier
yeah,
pigeons, maybe.
for
Probably not.
couple kernels of corn at a time, go fly to China. Hey, you
Yeah.
save on gas that way. But yeah. But I kind of agree with you. I don't know if that rail strike's actually going to happen. We've talked about that, a couple of weeks ago, and then got averted. Maybe it happens again. I don't know. I'm very concerned about exports, but the market so far hasn't been overly concerned. So I'm trying to
Mhm.
temper my concern, and the way I can do that is say, hey, it's really early in the marketing year. We have time to catch up on corn. Soybeans, again, we've seen the sales. There are a couple good weeks that needs to keep up. So it's not quite time to hit that panic button yet, Jesse. But I'm finger on the trigger, I suppose.
Yeah. What about guys looking at the cash basis side? Maybe they're selling right off the combine right now, whether it's corn or beans. We're in the gut slot of harvest. We still got good numbers on the board. And I see some basis in some areas, depending on where you're at, still relatively firm. What are your
Yeah.
thoughts on the cash side, real quick?
Yeah, basis is going to be extremely regional and localized this year. So if you're along the river, you have to be very worried about what that basis is going to do. Because at some point, when the big boys start hitting their capacities, where's it going to go? So that's the concern. On the other hand, if you're along the rail that's headed to the Pacific Northwest, you have to figure, hey, this basis might actually get a bit better. Same thing with the really heavy drought-stricken areas that have a lot of feed needs in Western Plains, right? So, it really kind of depends on where you are. That being said, when you talk about flat price, like I said, I've got my concerns about those exports, about what basis is going to do. That river basis is what the board pays the most attention to. And if that basis starts dropping aggressively, you'd think the board's going to have to follow, and let the basis in other areas improve to really deal with the cash drain on that side. So,
Hmm.
yeah, I really don't mind selling off the combine at these prices. I think there are some places that you might want to flat price and leave basis open for future delivery. Just trying to be kind of cute there. If you have access to railhead of the Pacific Northwest in particular. But man, we're at really good prices. There's a lot of dark clouds on the horizon. Whether we see a big flush out or not in the short to midterm, I don't know. But the question you have to ask yourself though is, we've been at or near, historically high prices for going on 2 years now. At some point, the idea is that high prices are the cure for high prices. We get demand destruction. We get more supply coming out of the woodwork. Brazil's about to plant the biggest crop the world's ever seen. Um, at some point, the high prices aren't justifiable anymore. And the longer we go on up here, the more likely it is coming soon that we come off the highs. And I'm also going to say the longer that we're up here, the more painful it might be in the longer run. So, you should be looking at 23 sales. I really do think that you should be going as far out in time with as much as you can, um, with different levels and different kinds of protection. I'm not saying you need to flat price everything super far out, but if you can own some puts in 23, if you can just do some things to manage your downside risk here, I think it's a great idea.
Ted Seifried, Zaner Ag Hedge, is our guest today here on Market Talk. Ted, talk to me a little bit about what you're seeing with the macro picture in the stock market. We had a lot of earnings reports here this past week. I noticed a lot of the social media earnings were down pretty heavy on Friday. We saw the Dow, Nasdaq, S&P all kind of rally Friday with the dollar breaking. What are your thoughts with what we're seeing on this macro picture as we wrapped up the week?
I mean, we're having a pretty decent bounce off the lows, and you do have a nice little double bottom there on the Dow, and the S&Ps, and so on and so forth. Now, is this going to be the low? Or are we just headed straight higher from here? As the stock market likes to do, the stock market likes to put in sort of surprise lows and just turn it and rip higher before we think that it's time for that to happen. But I don't know, Jesse. I really don't know. I really don't get the Fed feeling that the Fed is going to let off the pedal to the metal on the interest rate hikes. And if they continue to raise interest rates, it affects so many things that it becomes very difficult to say that the stock market's done going down, because I really don't think the American public has really felt the effects of these higher interest rates quite yet. People are still spending money, right? We haven't felt the effects of a housing market bubble burst. I don't know if we'll see a bubble burst, but if rates keep going higher, Jesse, I mean, there's going to be a lot less people buying houses, and if there's a lot less people buying houses, then there's not a whole lot propping up the value of houses, and yeah, so that's a concern. I mean, I'm still really very concerned about the economy, but again, then you look at a chart of stocks, and you've got outside reversal days. In fact, you've got one, two, three of them happening in less than a month, Friday included, right? And so you get below the previous day's low, and then you turn around, go above the previous day's high. These are a lot of times sort of flagging symbols. It's not a lot of people say key reversal is indicative of a top or a bottom. I don't say that. I don't think a key reversal means a top or a bottom. But a lot of times they can be warning flags that, hey, maybe we're close to something like that. It's just something to make you pay more attention to that chart. And when you get three of them like that, and I'm looking at the Dow right now, you get three of them like that in less than a month, happening, it's sort of different levels on the chart. That might be saying something. And then going back to the dollar, you have the exact opposite happening in the dollar. You have reversals lower, a key reversal after a new contract high, but then two more follow-up reversals lower in less than a month. So are things changing overall? Sometimes the charts know things before we do, Jesse, and maybe, but fundamentally, I have a hard time thinking that's the case. So this brings up the age-old question: what do you trust more? Do you trust your charts, or do you trust your fundamental analysis? And I think right now, when it comes to the overall economy, when it comes to the stock market, when it comes to the dollar, you've got you got a big conflict between what your brain's telling you and what your eyes are seeing on a chart.
Ted, crude oil kind of just traded either side of unchanged. Friday, ethanol was up on the week. You mentioned diesel prices being high still. Gas is ebbing and flowing. What are your thoughts on this energy market right now?
Well, ethanol should get a real big boost because natural gas is just in a complete free fall, and that's a very important component of making ethanol. It's the second largest cost, other than corn. So, I mean, it stands to reason that ethanol should be more profitable with lower natural gas. Ethanol should be stronger. The diesel situation, wow, it's tough to see really high price diesel in the beginning of fall, really, because diesel, i.e., heating oil.
Mhm.
I mean, we usually see our seasonal peak there in January, February. So, is that suggesting we've got a whole lot longer, a whole lot further way to go higher? Wow, I don't know. If that's the question, you worry that at some point, that really starts cutting into demand from the trucking side of things. You also have a lot of retailers that are built up or backed up on stocks, so you might start to see that demand destruction occurring in diesel at some point. But for soybean oil, we know that's a really positive thing. The strength in diesel in heating oil is a really positive thing for soybean oil, renewable energies, to some
Mhm.
extent ethanol as well. Um, a lot of people want to argue that crude oil needs to go quite a bit higher based on diesel and things like that. It's tough to argue against that, especially since we've really at this point kind of depleted the strategic oil reserve. Yet the crude oil chart's been very reluctant to go higher. I think there's a good chance that OPEC ends up producing more than what they were saying when they announced their 2 million barrel cuts. A lot of times OPEC will say something and then do the opposite.
Mhm.
They take plays out of the Chinese playbook. Um, Maybe that happens, and if that is what's happening, then yeah, okay, crude oil probably does not need to go higher. But I don't know, the energy fundamentals uh, have been really bullish for quite some time. Yet we're well off our highs and having a hard time going higher. So there too, go back to what we were talking about in the U.S. dollar and the stock market. Your fundamental brain says one thing, and then the chart says another. So it's tough to see. It's tough to say what we really should trust right now.
Mhm.
That being said, it does feel like crude is maybe done going down for the time being, possibly. Although you have days like Friday where we're really trying to go higher, and then that rally kind of falls flat on its face. So maybe it's just sideways for now. I don't know.
Well, Ted, lastly, before we wrap it up today, livestock trade, cattle on Friday felt like they were just kind of firming up ahead of that cattle on feed report out Friday afternoon. Anytime this hog market, I've noticed this trend quite a few sessions recently. Hogs start slow and
Hmm.
then boom, like a car crash mid morning, rocket higher. And that December contract now pretty close with that cash index. It's been a nice recovery in this hog market here from the, September sell-off we saw.
Yeah, I mean, that was the big thing that we've been saying about hogs is that, wow, look at the discount to cash. This is crazy. This is super abnormal. And well, we fixed that problem. So now what is the question? Um, I mean, it's been a really impressive rally in the hogs. You ran into a very key trend line resistance area on Thursday with Thursday's high, and then we just blew through it there on Friday. So that's really impressive. That being said, we're getting really overbought now, Jesse. RSIs are up to near 70%, which the last time we got up RSIs up to this level, that was our August high, and we had a pretty stiff correction after that. So you would think that maybe we'll cool this off here at some point. Um, but you got to go back into why the hog market fell off the way it did, especially from that mid-September sell-off. It was triggered by the idea that China was releasing a lot of their state reserves because they were trying to uh, calm down their pork prices. Uh, the thought there was that they were going to stop importing from the U.S. That hasn't happened. In fact, our exports, not just to China, but really our exports in general, have been pretty good. But what that did is that break that you had that started from the China news in mid-September caused the funds to really want to get out, and you had this precipitous drop that happened. we overextended to the downside, and we got way too cheap compared to where cash was. So now we've corrected that. And the question is, where do we go from here? Does China continue to buy? Now we're at different prices. Their hog market is still pretty pricey. So I think the fundamentals are such that we should be trading up at these price levels. I'm just not sure we need to get up and continue to go higher and break those highs that we have. I mean, we've got a series of highs between
Mhm.
90 and 92. I don't know if we have to go much over that quite yet, but it's been a nice bounce. I'd look for a bit of a pullback, and then it might be interesting to see some ownership there.
Well, Ted, we're out of time. We're up against the clock, buddy, but I appreciate it as always. If folks want to talk to you and the team there at Zaner Ag Hedge, get a little advice with their marketing plan, what's the best way to get a hold of you guys, Ted?
Absolutely, Jesse. You can reach me directly at 312 Aside from that, you can find us on the web at www.zaner.com. Read a bit about us, look at our bio, sign up for our morning Ag Hedge newsletter. Also, if you're on Twitter, I'm at the Ted Spread. I like to have a little bit of fun on Twitter.
He is a fun follow on Twitter, that is for sure. Ted, always a pleasure, buddy. Thanks for joining us this week. Have a good one, and we'll talk to you again real soon.
Thanks, Jesse. Appreciate it, man. Talk to you soon. Have a great
Ted
weekend.
Seifried. Thanks, buddy. Ted Seifried with Zaner Ag Hedge joining us here today on Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.